Most traders think that success comes from finding the perfect entry signal, the holy grail indicator, or some secret strategy that the pros don't want you to know. They spend hours backtesting systems, watching YouTube videos, and tweaking parameters, hoping to stumble upon the edge that will finally make them profitable. They study candlestick patterns until their eyes burn. They memorize support and resistance levels like religious scripture. They subscribe to every trading service and follow every guru who promises the secret sauce. But they're looking in the wrong place entirely. The difference between profitable traders and everyone else isn't found in their charts. It's not hidden in some complex algorithm or mysterious market structure that only the insiders understand. It's found in what they do for 5 minutes every single day when the markets are closed. This habit is so simple that most traders dismiss it as pointless, so boring that it feels like a waste of time, so unglamorous that it doesn't even feel like trading. But it's the foundation that separates those who consistently make money from those who consistently lose it. The habit is this: every evening, after the markets close, they sit down with a notebook and review their trading day. Not their P&L, not their win rate, not the news events or economic data that moved the markets. They review their process. They examine their emotional state. They dissect their decision-making like a surgeon performing an autopsy for exactly 5 minutes, no more, no less, and in those 5 minutes, they build the mental framework that turns ordinary traders into consistently profitable ones. This might sound like journaling, and in a way, it is. But it's not the soft, feel-good kind of journaling that focuses on gratitude and positive thinking. This isn't about writing down your hopes and dreams or visualizing success. This is forensic analysis. It's the kind of brutal self-examination that most traders are too uncomfortable to do, because it forces you to confront the truth about why you really lost that trade, why you really broke your rules, and why you really keep making the same mistakes over and over again. The uncomfortable truth is that most trading failures aren't technical failures. They're psychological failures disguised as technical problems. Let me tell you about a trader I knew in Chicago back in 2005. His name was Marcus, and he'd been trading futures for 3 years. On paper, everything looked right. He had a solid understanding of market structure. His technical analysis was sharp enough to impress seasoned professionals. His risk management rules were clearly defined and mathematically sound. He could explain concepts like order flow and market sentiment better than most trading educators, but somehow, he kept sabotaging his own progress. One month he'd be up $3,000, feeling like he'd finally cracked the code. The next month he'd give it all back and more, usually in spectacular fashion. A single day of revenge trading would wipe out weeks of careful gains. He was convinced the market was personally targeting him, that algorithmic traders were hunting his stops, that the whole system was rigged against the small guy. Sound familiar? Then his mentor, a former pit trader who'd survived the transition from open outcry to electronic trading, introduced him to what he called the daily debrief. The concept was devastatingly simple. Every evening at 6 p.m., regardless of whether he'd made money or lost money that day, Marcus would spend 5 minutes writing answers to 3 specific questions. What did I do well today? What did I do poorly today? What was I feeling when I made each decision? That's it. Nothing fancy, nothing complicated, no complex psychological assessments or deep emotional diving. Just 5 minutes of honest reflection. At first, Marcus resisted it like his life depended on it. It felt like homework assigned by a teacher he didn't respect. It felt like punishment after a losing day, like rubbing salt in an open wound. On profitable days, it felt like a waste of time that could be better spent planning tomorrow's trades or studying new setups. But his mentor was persistent. You can keep doing what you're doing and get the same results, he said, or you can try something different and see what happens. After 2 weeks of grudging compliance, something strange started happening. Marcus began to see patterns in his behavior that he'd never noticed before. Crystal clear patterns that had been hiding in plain sight for 3 years. He realized that his biggest losses always came when he was feeling frustrated about missing an earlier move. The FOMO was so intense that he'd chase entries at terrible prices, justifying it with increasingly creative technical analysis. He discovered that he traded best in the morning when his mind was fresh and decisive, and worst in the afternoon when mental fatigue made him second-guess everything. He noticed that he broke his rules most often when he was trying to make back money he'd lost earlier in the day, turning disciplined trading into emotional gambling. But the most shocking pattern was this. Every single one of his revenge trades happened within 30 minutes of checking his P&L. The very act of looking at his account balance was triggering destructive behavior. These weren't earth-shattering revelations that required a PhD in psychology to understand. They were simple observations about his own behavior. But they were observations he'd never made before because he'd never stopped to look. He'd been so focused on what the market was doing that he'd completely ignored what he was doing. Within 6 months, Marcus's trading had completely transformed. Not because he found a new strategy or discovered some hidden edge in the market. His technical approach remained exactly the same. But he finally understood himself as a trader. He stopped checking his P&L during trading hours. He implemented a mandatory 15-minute break after every loss before he could place another trade. He scheduled his most important trades for the morning when his decision-making was sharpest. The results were immediate and dramatic. His win rate stayed the same, but his losses became smaller and more controlled. More importantly, he stopped giving back his gains. By the end of that year, he'd had his first consistently profitable year in trading. By year 2, he was managing money for other people. By year 5, he was running a small hedge fund. The power of this habit isn't in the writing itself, it's in the awareness it creates. Most traders operate on autopilot, making decisions based on impulse, emotion, and subconscious patterns they don't even realize they have. They're like drivers who've been speeding for so long they don't realize they're breaking the speed limit until they see the police lights in their rearview mirror. The 5-minute review breaks that autopilot. It forces you to examine your actions consciously, to slow down and actually see what you're doing. And once you can see your patterns clearly, you can start to change them. But here's where most traders go wrong when they try to implement this habit. They focus on the wrong things entirely. They write about their trades, their profits and losses, their market predictions for tomorrow. They turn it into a trading diary instead of a psychological autopsy. They document what happened instead of examining why it happened. This is like a doctor treating symptoms instead of diagnosing the underlying disease. The profitable traders know that the external results don't matter nearly as much as the internal process that created those results. They understand that every trade is actually two trades, the trade with the market and the trade with themselves. And the second trade is always more important than the first. For example, instead of writing loss $200 on euros because it reversed after the ECB announcement, a profitable trader writes entered euros while feeling impatient after missing the morning breakout, ignored my rule about not trading during news events, was so focused on making back this morning's missed opportunity that I violated my own risk management. Need to implement a 10-minute cooling off period after missing any setup. See the difference? One focuses on what the market did, which is completely outside their control. The other focuses on what the trader did and why they did it, which is entirely within their control. The most successful implementation of this habit I've ever witnessed came from a prop trader in New York named Sarah. She started with a $25,000 account in 2010, fresh out of college with a finance degree and absolutely no real trading experience. Like most beginners, she thought success would come from finding the right strategy and following it mechanically. She was wrong. For her first 6 months, she was the definition of mediocrity. Some days up, some days down, but overall just churning. Her account with nothing to show for the stress and effort. Her firm was starting to make noises about cutting her loose if she couldn't show consistent progress. That's when she discovered the daily review process. But Sarah took it further than anyone I'd ever seen. Every evening, she would answer the same 5 questions with surgical precision. What emotions did I feel today while trading? Which emotions led to my best decisions? Which emotions led to my worst decisions? What specific triggers caused those negative emotions? How can I better manage those triggers tomorrow? This wasn't abstract emotional analysis or touchy-feely self-help nonsense. This was tactical psychology. She was treating her emotions like variables in a trading system, something to be measured, understood, and optimized just like any other component of her edge. She discovered that her best trades came when she felt calm and slightly bored. Her worst trades happened when she felt excited or anxious. So she started using her emotional state as a filter for trade quality. If she wasn't feeling calm and slightly bored, she wouldn't trade, period. She noticed that her judgment was compromised for exactly 47 minutes after any loss greater than $100. So she implemented a mandatory break of 1 hour after any significant loss, regardless of what opportunities might appear. She realized that she traded poorly on days when she'd had arguments with her boyfriend or when she'd gotten less than 7 hours of sleep the night before. So she started tracking her sleep and relationship stress as leading indicators of her trading performance. Within 18 months, she'd grown that $25,000 account to over $200,000. The firm promoted her to their main trading floor and doubled her capital allocation. When asked about her success, she said something that I've never forgotten. I realized that I wasn't really trading the market. I was trading my reactions to the market. Once I understood my reactions, I could control them. And once I could control them, the market became predictable in a way I'd never experienced before. The 5-minute habit works because it addresses the root cause of most trading failures: lack of self-awareness. You can have the best strategy in the world, but if you don't understand your own psychological patterns, you'll find ways to sabotage it every single time. You'll break your rules when you're frustrated. You'll risk too much when you're overconfident. You'll hesitate when you should act decisively and act impulsively when you should hesitate. The review process catches these patterns before they become expensive habits. There's also a compound effect to this practice that most traders don't anticipate. In the beginning, you're just documenting your mistakes after they've already cost you money. But over time, something remarkable happens. You start to recognize the patterns as they're developing. Eventually, you begin to catch yourself before you make the mistakes at all. It's like developing a trading conscience that speaks up at exactly the right moment. Instead of realizing after the fact that you broke your rules, you hear that voice during the trade saying, "Wait, you're about to do that thing you always regret." I've seen traders who, after months of consistent review, could predict their own behavior with startling accuracy. They'd recognize the emotional state that preceded their worst decisions and immediately step away from their computer. They'd feel the familiar tug of FOMO and automatically implement their cooling-off protocols. They'd notice the early signs of overconfidence and reduce their position sizes before they made emotional mistakes. This is why the habit must be done consistently, even on days when you didn't trade. Especially on days when you didn't trade. Because sometimes the most important insight is understanding why you chose not to trade. Was it because there were no good setups? Or was it because you were afraid after yesterday's loss? Was it disciplined patience? Or was it paralysis masquerading as patience? The answer to that question tells you everything about your mental state and whether you'll be ready for tomorrow's opportunities. One of the most powerful aspects of this practice is how it fundamentally changes your relationship with losses. Most traders see losses as failures to be forgotten as quickly as possible. They want to move on, put it behind them, and focus on the next opportunity. This is exactly backward, but traders who do the daily review start to see losses as data, to be analyzed, as expensive lessons that shouldn't be wasted. They ask completely different questions. Instead of "why did I lose?" they ask what led me to enter that trade in the first place. Instead of "why didn't my strategy work?" they ask, did I actually follow my strategy, or did I modify it in real time based on fear or greed? This shift in questioning leads to completely different insights and much faster improvement. I remember reading about a trader named David who kept a detailed review journal for over 5 years. When he looked back at the early entries, he was amazed at how dramatically his thinking had evolved. In the beginning, his entries were full of blame and external attribution. The market was against him. The news was unexpected and unfair. Other traders were manipulating prices. Economic data was misleading. His broker was slow. His internet connection was unreliable. But over time, the entries became more focused on his own decisions and actions. He stopped seeing himself as a victim of external market forces and started seeing himself as an active participant who had complete control over his own results. The shift wasn't immediate, but it was undeniable when viewed over months and years. The habit also serves as an emotional reset between trading days, which is crucial for long-term success. Instead of carrying the stress, frustration, or overconfidence from today into tomorrow, the review process allows you to examine those feelings, understand where they came from, and then consciously let them go. You start each new trading day with a clear head instead of emotional baggage from previous sessions. This is enormously powerful because most traders carry their emotions from one day to the next, creating negative feedback loops that can last for weeks. But perhaps the most important long-term benefit is that it turns you into your own trading coach. Most traders think they need someone else to tell them what they're doing wrong. They look for mentors, expensive courses, or exclusive chat rooms to provide guidance and accountability. They want someone else to fix their problems and show them the way. But the traders who implement this habit discover that they already have access to the best trading coach possible, themselves. The review process teaches you to ask the right questions, identify your own weaknesses, and develop your own solutions. You become intimately familiar with your own psychology in a way that no external coach ever could be. The key to making this work is to make the process completely non-negotiable. It doesn't matter if you made money or lost money. It doesn't matter if you took one trade or 20. It doesn't matter if you're tired, busy, stressed, or just want to forget about trading for the day, 5 minutes, every single day. No exceptions, because the days you least want to do it are often the days you need it most. The format is simple, but it must be specific and systematic. Vague questions lead to vague insights that don't change behavior. Instead of "how did I trade today?" ask "what was my emotional state during each specific trade entry and exit?" Instead of "what went wrong?" ask "at what exact moment did I deviate from my plan and what was I thinking and feeling at that precise moment?" The more precise your questions, the more useful your answers will be. The more useful your answers, the faster you'll improve. After 6 months of this practice, something remarkable happens that goes beyond just better trading results. You stop being surprised by your own behavior. You start to see your patterns so clearly that you can predict your own reactions to different market scenarios. And once you can predict them, you can prepare for them. You can build safeguards and protocols that protect you from your own worst instincts. You become a different type of trader entirely. Not just someone who knows how to read charts and identify patterns in price action, but someone who knows how to read themselves and identify patterns in their own decision-making process. This is the real edge in trading, not some secret indicator or hidden pattern in market structure. Not some inside information or proprietary algorithm. It's the ability to understand and control your own decision-making process under the intense pressure that only real money can create. Because at the end of the day, the market doesn't care about your strategy. It doesn't care about your analysis, or your predictions or your technical skills. It only cares about the actual decisions you make when there's real money on the line and your emotions are running high. And those decisions are driven by psychological patterns that most traders never take the time to understand, let alone master. The 5-minute habit isn't glamorous. It won't give you the adrenaline rush of a big win or the excitement of discovering a new strategy. It won't make for impressive social media posts or trading room highlights, but it will give you something much more valuable and much rarer: the ability to learn from every single trading experience, good or bad, and compound that learning over time. And in a game where most participants never improve beyond their first year, where the majority of traders repeat the same mistakes indefinitely, the ability to continuously learn and adapt is the ultimate competitive advantage. So tonight, before you close your laptop and walk away from your trading setup, take 5 minutes, not to check one more chart or read one more article about tomorrow's economic releases, but to examine the trader in the mirror. Ask yourself the hard questions that most people avoid. Write down the uncomfortable truths that most people prefer to ignore. Because the trader who can see themselves clearly is the trader who can change themselves permanently. And that change, compounded over months and years, is what separates the consistently profitable from everyone else who's just hoping to get lucky. The market will teach you everything you need to know about trading, but only if you're willing to learn from what it's trying to tell you about yourself.